For years, the gold and silver markets moved in a fairly predictable pattern. Traders bought and sold paper contracts on major exchanges. Prices rose and fell based on speculation, interest rates, and investor sentiment. But this past week, something changed. According to a detailed report from Gold Money Trading Conditions on the COMEX, the major U.S. commodities exchange, suggests that something unusual is building beneath the surface. The report points to one striking detail. Open interest in the gold market, meaning the number of active futures contracts, has dropped to levels not seen since 2015. Back then, gold was trading near $1,050 an ounce, right before it began a decade-long climb that eventually pushed prices past $4,500. Analysts now say the current drop in open interest signals something similar. Speculators, who typically drive prices through buying and selling paper contracts, have largely stepped away from the market. This matters because when those speculators eventually return, as they historically do, they tend to buy in large volumes. Analysts estimate that if speculators re-enter at levels similar to past cycles, it could mean 300,000 to 400,000 new contracts flooding back into the market. That kind of sudden demand has, in the past, driven prices sharply higher in short periods of time. The same pattern is showing up in silver. Data reviewed in the report shows COMEX open interest for silver has also fallen to historically low levels, echoing what happened with gold nearly a decade ago. Market sentiment, according to the analysis, is now similarly bearish to the period seen in 2015 and 2016, a time that came right before both metals began major upward moves. But it isn't just about speculation. A larger structural shift appears to be underway. The report explains that markets are slowly moving away from paper-based trading and toward physical settlement. Traditionally, contracts for gold and silver were settled with cash or paper agreements rather than actual physical metal changing hands. Now, according to the analysis, more buyers, especially in Asia, are demanding real physical delivery instead. China is described as playing a central role in this shift. The country has been accumulating physical bullion for years, and it's now aggressively developing Hong Kong as a major bullion trading hub. Singapore, according to the report, has similar ambitions. Both financial centers are expected to require banks to hold larger amounts of actual physical gold and silver to back their trading contracts, rather than relying on paper promises. This shift matters because the pricing mechanism for gold and silver has historically been controlled largely through paper markets in London and New York. If physical demand from Asia continues to grow at this pace, it could reduce the influence that Western paper markets have traditionally held over global prices. The timing adds another layer to the story. Just last week, two major economic reports were released in the United States. On Wednesday, ADP released private payroll data showing weaker than expected job growth. On Thursday, the Bureau of Labor Statistics confirmed the trend with its own employment report. According to Moneys and Metals, these reports showed a clear 4-month decline in job growth, which shifted market expectations about future interest rate decisions. For months, the Federal Reserve had maintained a hawkish stance, citing a strong labor market as justification for keeping interest rates elevated. But the weaker jobs data appears to have changed that narrative almost overnight. Markets began repricing expectations for interest rate cuts, and gold and silver prices responded quickly, moving higher in the hours following the reports. Together, these developments paint a picture of a market experiencing several major shifts at once: shrinking paper market activity, rising physical demand from Asia, and a sudden change in U.S. economic expectations. According to analysts, this combination hasn't been seen quite this way in years, and it's part of why some are calling this moment a turning point worth watching closely. To understand why this moment feels different, it helps to understand how the COMEX and LBMA actually work. The COMEX, based in New York, is one of the largest exchanges in the world for trading gold and silver futures contracts. Most trades in the COMEX are settled in cash or paper agreements, meaning very little physical metal actually changes hands. The LBMA, based in London, operates similarly, acting as the center of the global over-the-counter gold and silver market. For decades, these two exchanges have effectively set the world price for both metals, even though the amount of physical metal backing those trades has often been small compared to the total value of contracts traded. This system worked smoothly for a long time because most participants were content to trade paper promises rather than demand actual delivery. But according to the Gold Money report, that balance appears to be shifting. As physical demand grows, particularly from Asia, more participants are choosing to take real delivery of metal instead of settling in cash. This creates pressure on exchanges that were never designed to handle large-scale physical withdrawals. China's role in this shift is significant. The report notes that China has, until recently, helped keep global silver prices relatively low by supplying physical silver to the market. However, that changed dramatically last year. Silver prices jumped from under $50 an ounce to more than $120 at one point. a move the report attributes partly to China stepping back from its role of keeping supply steady and prices suppressed. Once that changed, existing paper contracts in silver became more exposed to sudden price swings since there was less physical supply available to meet demand. Meanwhile, Hong Kong has been making significant regulatory moves of its own. According to reporting from David Lee, an analyst following developments in China, the Hong Kong Stock Exchange will waive gold futures trading fees for 1 full year, starting July 6th. This is described as part of a broader effort to build Hong Kong into a major global center for gold trading, separate from the traditional dominance of London and New York. The effects of this policy are already being felt. The report states that a large number of standard 400-ounce gold bars, the type typically used for institutional delivery, are being shipped from London to markets in Asia. Analysts quoted in the report suggest this could increase short-term volatility in London's gold market. If more global and local banks choose to participate in Hong Kong's new system, the city could gradually shift from simply accepting prices set elsewhere to becoming an active participant in setting global gold prices itself. On the banking side, HSBC, one of the world's largest international banks headquartered in London, has also weighed in. According to Kitco News, HSBC's Ernest Hoffman stated that the bank anticipates further upside for gold by the end of the year. HSBC's outlook does note some near-term headwinds, including elevated U.S. Treasury yields and a strong U.S. dollar, both of which can make gold and silver less attractive compared to interest-bearing assets in the short term. However, the bank also pointed to several supportive factors, including steady central bank buying, consistent inflows into gold-backed exchange-traded funds, and continued portfolio diversification demand from investors who remain underallocated to precious metals. On the supply side, silver faces its own unique challenge. Data shared by analyst Oliver Gross shows that primary silver producers, meaning mining companies that get most of their revenue specifically from silver, are extremely rare. Even well-known silver mining companies often earn a large share of their revenue from gold instead. That's because roughly 70% of the world's silver supply is produced as a byproduct of mining other metals, like copper, zinc, and lead, rather than being mined directly. This means that even when silver prices rise, there isn't necessarily a quick increase in new supply to meet growing demand, adding another layer of pressure to an already tightening market. The shifts happening in the gold and silver markets are not just technical details for traders to watch. They carry real consequences that reach everyday investors, retirement savers, and entire economies around the world. Economically, the most immediate impact is on price stability. As physical demand grows and paper market activity shrinks, prices can become more volatile. Analysts quoted in the Gold Money report suggest that when speculators eventually return to a market with historically low open interest, the resulting demand could push prices sharply higher in a short period of time. For everyday investors holding gold or silver, this could mean significant gains. But for those who use precious metals as a stable, predictable store of value, it could also mean more unpredictable price swings along the way. There's also a broader implication for the global financial system. For decades, the price of gold and silver has largely been determined by trading activity in London and New York. If that influence continues shifting toward Asian markets, particularly Hong Kong and China's Shanghai Gold Exchange, the balance of power in global commodities pricing could change in a lasting way. This wouldn't just affect large financial institutions. It could eventually influence how mining companies plan future projects, how central banks manage their reserves, and how everyday people in different countries access and price physical metal. Central bank behavior adds another layer to this story. According to the report, steady central bank buying has been one of the key supportive factors for gold prices. Many central banks around the world have been increasing their gold reserves in recent years, often as a way to diversify away from holding large amounts of US dollars or treasury bonds. If more countries continue this trend, it could reduce reliance on the US dollar in global trade and reserves over time, a shift that would carry significant political and economic weight. There are also social and generational implications worth considering. The report highlights that Indian households are estimated to hold a substantial amount of gold, often passed down through generations as jewelry, coins, and family wealth. This reflects a cultural relationship with gold that differs significantly from how many Western households view precious metals, often as an investment rather than a form of savings woven into daily life. As physical demand from countries like India and China continues to grow, it highlights differing approaches to wealth preservation across cultures and how those approaches are now beginning to influence global markets in a more visible way. From an economic policy perspective, the recent U.S. jobs data adds further complexity. Weaker employment numbers, confirmed by both ADP and the Bureau of Labor Statistics, have shifted expectations around Federal Reserve policy. For months, the Fed maintained a hawkish stance, keeping interest rates elevated to manage inflation. If the labor market continues to soften, the Fed may face pressure to lower interest rates sooner than previously expected. Lower interest rates generally make non-yielding assets like gold and silver more attractive to investors, since the opportunity cost of holding them compared to interest-bearing investments decreases. It's important to present these developments with balance. Not all analysts agree on how quickly or dramatically these shifts will play out. Some caution that markets can remain unpredictable, and that structural changes, like the move toward physical settlement in Asia, often take years to fully materialize rather than happening overnight. Others believe the changes already underway, including Hong Kong's new fee waivers and shifting bullion flows, represent an early stage of a much larger transformation in how gold and silver are priced globally. So where does this leave everyday investors, savers, and anyone simply trying to make sense of their financial future? That's a question worth sitting with, because the answer isn't the same for everyone. Some viewers may already hold gold or silver as part of their savings. Others may be watching these developments for the first time, wondering whether precious metals deserve a place in their financial planning. Either way, this is a moment worth paying attention to. Viewers watching tonight might ask themselves a few simple questions. Has their own view of gold and silver changed after learning how much physical demand is shifting toward Asia? Do they see these markets as a long-term store of value, or simply another investment to watch rise and fall? There's no single right answer, but it's worth thinking through. Looking ahead, several developments are worth watching closely in the coming months. Hong Kong's new fee waiver program for gold futures officially began this week, and its effects on trading volume and physical gold flows will likely become clearer over the next several weeks and months. If more global banks choose to participate, it could accelerate the shift toward Hong Kong becoming a more influential pricing center rather than simply following prices set in London or New York. The Federal Reserve's next moves also remain an important factor. With recent employment data showing signs of a softening labor market, attention will likely turn to upcoming economic reports and Federal Reserve meetings. Any shift toward lower interest rates could continue to support gold and silver prices, since these metals often become more attractive to investors when returns on cash and bonds decline. On the supply side, developments in the silver mining sector are also worth following. With so few primary silver producers in the world, any new mining projects, expansions, or delays could have an outsized effect on available supply, especially if demand continues to outpace what the mining industry can provide. New projects currently being developed in places like Peru may offer some insight into how quickly supply could respond if prices continue climbing. For those looking to stay informed, it's worth following updates directly from credible financial news sources, central bank announcements, and official statements from major exchanges like the COMEX, LBMA, and Hong Kong Stock Exchange. Understanding the mechanics behind these markets, rather than reacting to short-term price movements alone, tends to lead to more thoughtful, well-informed decisions over time. It's also worth remembering that markets like gold and silver have moved through many cycles over the decades, shaped by shifting economic policies, changing global trade relationships, and evolving investor behavior. What's happening right now, the shift toward physical settlement, the growing influence of Asian markets, and changing Federal Reserve expectations, reflects just one chapter in a much longer story that has played out many times before in different forms. Viewers are encouraged to share their own thoughts and questions in the comments below. What matters most to them when it comes to precious metals? Long-term stability, potential growth, or simply diversifying their financial future? Every perspective adds to a richer conversation, and hearing from viewers across different backgrounds and experiences helps make these discussions more valuable for everyone watching. As always, Golden Crest Finance will continue following these developments closely, bringing clear, balanced coverage as new information becomes available. Markets can shift quickly, but staying informed doesn't have to be complicated. It simply requires paying attention to the facts, understanding the forces at play, and making thoughtful decisions based on solid information rather than speculation. Thank you for spending this time with Golden Crest Finance today. Whatever path gold and silver take next, staying informed remains one of the most valuable tools any investor can have. Until next time, take care, stay curious, and we'll see you in the next episode.